Hello and welcome everyone. My name is Cooley. I am the Targeted Outreach Director for the Department of Financial Protection and Innovation. Thank you for joining us. I'm going to give everyone, I know it's right at 12, so I'm going to give everyone another minute to get logged in before we get started. So thank you for your patience. We will get started shortly. Thank you. Okay, good afternoon, everyone. Again, my name is Cooley. I am the Targeted Outreach Director for the Department of Financial Protection and Innovation. Thank you for joining our webinar. A lot of really great information today. Let's go ahead and get started. Again, today's webinar is about safe and successful investing strategies. Let's jump right in. First, a little bit of housekeeping. Um, the views and opinions expressed in this presentation are those of the presenters. They do not necessarily reflect the views or positions of the FBI. This presentation is for educational and informational purposes only. This is not financial advice and does not replace independent or professional judgment. The DFPI does not assume responsibility for the completeness of this information. Please do your own research if you want to learn more about any of these topics you hear in this presentation. This is just a very high level overview. This webinar is being recorded and it will be published to the DFPI's YouTube channel. Because of that, your cameras and microphones have been turned off. But if you do have a question, please submit it through the Zoom's Q&A feature. We have a dedicated live Q&A session at the very end, and we're going to answer as many questions as we can. All right. Who is the DFPI? What do we do? So the DFPI is California's licensing and regulatory agency of state financial institutions, products, and professionals. So state chartered banks and credit unions, payday lenders, student loan servicers, investor broker investment advisors. We license and regulate them. We also conduct exams to ensure compliance and review consumer complaints that are submitted to us. We also pursue legal actions against those who are operating illegally or are using unlawful, deceptive, or abusive business practices. Something else a lot of people don't know is that the DFPI provides consumer awareness presentations, just like this, webinars, on financial education topics, protecting yourself from fraud. We provide those presentations for free in partnership with other organizations throughout California. If you want to learn more, I have a link right there, dfpi.ca.gov/consumers. All right. A little bit about today's agenda. We're going to talk about defining your investment goals. We're going to go over some strategies for achieving those investment goals. Then we're going to talk about some investing types. So, stocks, bonds, all that. We're going to talk about doing research and risk management. And then big one here, we're going to talk about the power of compound interest. Then we're going to talk about investment scams and fraud, how to protect yourself, things to look out for. And then finally, I'm going to share some time with ScholarShare 529, which is a fantastic program. We have Diana Sanchez from ScholarShare to come talk about it. And then we do have a dedicated live Q&A session at the end. Again, please throw any questions you might have into the Zoom's Q&A feature. We will answer those at the end. All right. defining your investment goals. Okay, you could have a number of different investment goals, right? One of them is building generational wealth or wealth that you could pass on. Another one is you can have investing generate income for you, so things like dividends, or of course, appreciating over time and then selling those stocks or bonds or other investments later on. Um, Investments could provide you financial independence and security, right? That could be one of your goals. Of course, diversifying your portfolio of other capital, right? Um, Retirement planning, education funding. So ScholarShare 529, it's a great program for education funding later on. Tax efficiency, right? You could use investing as a way to bring down your tax burdens and taking advantage of that. Another thing a lot of people don't think about, but is happening, is supporting social responsibility. So you might invest in a company that has particular social initiatives and you want to support that. So another investing goal there. And then another thing for investing is you might just want to make sure your money is beating inflation or the rate of inflation. So these are a lot of different investment goals. They're not mutually exclusive, which means you could have more than one investing goals. I would try to recommend, just focusing on a few that are important to you. Trying to achieve all of this would be very difficult because one would not take the priority over the other. So investment goals, incredibly important. Need to define them for yourselves. It gives you kind of a North Star, something you're shooting for. All right, just want to cover some investment strategies to achieve your investment goals. This again, this is not a comprehensive list. This is just some of the most popular investing strategies. Starting early, everyone says that. Start early, start investing early. Take advantage of that compound interest, which we will talk about later in this presentation. Paying off debts is a great way to actually get yourself started to investing if you don't have any debts that are burdening you. All that extra discretionary income you could use to put into your investments. Obviously, it talks about investment goals. You want to have clear investment goals. Diversifying your investment portfolio, right? You want to maintain a consistent financial budget and then regularly contribute to your investments. One of my mentors was telling me that the biggest reason why people don't have money at retirement, or they don't have money or can't reach their financial goals, is because they don't have a financial budget, or they don't start contributing to their investments. So just getting started is that huge first step. And then, of course, having a financial budget is that way to help guide you to understand what you can invest. And then, of course, what you should invest based on your investment goals. Do your research. That's a big thing that I push, and the DFPI pushes. You really want to do research on the best investment option for you, right? Don't look at what other people are doing. Don't look at what the TikTokers or those finfluencers are pushing out there. Your investment goals are yours. They're customized to you, and obviously doing your own research on what works for you is best, right? Don't invest in something you don't understand is another big one. If you don't understand what it is, it's better to just kind of stay out of it, right? Take advantage of any kind of employer sponsored retirement accounts. If you are employed and they have some kind of 401k, 403b that has any kind of matching, that's free money. Take advantage of it. And of course, protect yourself from investment fraud and scams. Huge one there, especially later on in your investment journey when you have a lot of asset value, wealth. You want to make sure to protect yourself. And this is one that I like to talk about. And some people may not consider taking care of your housing situation, right? The single biggest expense in your I don't want to say daily expense. Your single biggest expense on a yearly basis is usually your housing, whether you're renting, whether you're paying a mortgage, whatever it may be, and at whatever life point you're at, housing is your biggest expense. And so if you purchase a house, if you pay off a house, you remove that expense, and therefore that extra discretionary income can be used towards investing. So again, consider buying a house if that's within your goals. Huge one here, huge thing to mention. No investment is risk free, right? No investment. And big red flag if anyone is promising a risk free investment or guaranteed returns. No investment is risk free. Anyone promising you something otherwise is obviously just trying to sell you. All right. Popular investment types and risk. We'll dive deeper into a few of these, but this is just, again, a very high overview so that you get a very good understanding of all these different investment types. So we obviously have stocks, we have bonds, mutual funds, ETFs, also known as exchange traded funds. Real estate is an investment, commodities, collectibles, if that's your thing. We'll talk about that a little more. Certificate of deposits is a way to invest. Annuities, hedge funds, and of course, cryptocurrencies. So let's dive into each one of these investment types and talk about it. Again, I do want to invite you to submit your questions into the Zoom's question function so that we can answer those later. All right, stocks, also known as a share. It represents ownership of a company, its assets and earnings. There are different types of stocks, including common stocks and preferred stocks. It goes on and on. These are just, again, very high overview. The benefits of owning stocks is you generally get voting rights. That's more for common stocks. Sometimes they provide dividends, and dividends can be monthly, quarterly, yearly. It just depends on the stock. There's capital appreciation. That means the stock value grows. And then, of course, another benefit of stocks is high liquidity, which means you could sell the stock. You buy the stock, you sell it, and you get money back. So pretty easily done. That's why it has a high liquidity ability. The big thing about stocks, or the big risk about stocks, is that its value is based on the company's performance, its leadership's decisions, other stock owners and buyers' actions, market conditions, economic trends, current events. All of these things can affect the stock or the share value of a company. So things that you can consider when you're thinking about buying stocks. All right, bonds. Bonds represent lending money to a bond issuer, which could be a government, corporation, or other entity, in exchange for interest payments and the return of the bond's value at its maturity date. So, bonds, like I said, for the United States government, you're looking at T-notes, treasury bonds. You could buy those, you could purchase those. And then, of course, there's a certain amount for those. There's a maturity date as well, and then you get interest payments on those. So the benefits include, again, we talked about fixed interest payments to the bondholder. And typically, bonds have lower risks than other investments. And that's because bond issuers usually have a credit rating, and those credit rating talks about worthiness of the issuer. And normally those bonds could be secured, or again, using the credit rating of that organization who's issuing it. All right, risk to bonds. There's no growth, and generally there's lower returns. So what do I mean by there's no growth? Well, you purchase a bond at, let's say you buy a $100 bond. It's $100. It's not going to grow more except for the interest rates you get, or the interest payments you get. It's not going to double in value. It's just going to sit at the value which you purchased. There's also the possibility of the bond issuer defaulting on the bond, and particularly with lower rated bonds or bonds that are issued by organizations with lower credit ratings. So consider those risks. Mutual funds, an investment vehicle that pools money from multiple investors to purchase a portfolio of stocks, bonds, other securities. These funds are managed by a professional known as a fund manager who makes the investment decisions on behalf of the shareholders. So it's just a collection, a portfolio of bonds and stocks and other securities managed by a professional. you know, that's one of the benefits. You have someone who has a lot of, or should have a lot of understanding of the market, understanding of the bonds, securities, everything that is within that mutual fund, and the market as well. They're a professional. There's usually automatic diversification in that mutual fund, so the risk is spread out throughout all the different items in that portfolio, and it has high liquidity. So you could pool into a mutual fund, and you go purchase out of it as well, pretty easily. The risks involved is management fees. So mutual funds, depending on what kind of mutual fund, because there's all sorts of different types of mutual funds, they have a number of different management fees, and the fee structures are all different. So be very careful when you're looking to buy into a mutual fund. You want to make sure you understand how the fund manager is paying themselves, and then of course how they're managing that mutual fund. Um, the mutual funds have investment objectives, right? Something you also want to be very aware of. So they could be a growth mutual fund, it could be dividend or income mutual fund, it could be an international or maybe very sector specific. So like technology mutual funds. Mutual funds are just buying technology stocks, that kind of thing. So you want to again be very aware of that. Do your research. Mutual funds are, they're at risk by other stock owners, market conditions, economic trends. All that affects mutual funds. So things to consider. Okay, ETFs, exchange traded funds. A lot like a mutual fund, it's an investment fund that holds a diversified portfolio of assets, so stocks, bonds, commodities, etc., or even a different combination of securities. ETFs are traded on stock exchanges, similar to stocks. So benefits include, management with very low fees, relatively low fees. Transparency, so what assets, what securities are in the ETF. There's just diversification that's in there, and high liquidity. So you could buy the ETF and then you can sell it the same day. So quick, small, high liquidity. Risk. Well, since the ETF is just a portfolio of stocks and it's exchanged on the stock market, it's subject to the same actions of other stock owners and buyers, different market conditions, economic trends, current events, etc. So those are those risks. Real estate. So real estate is a tangible property or asset. It could be land, the buildings on the land, etc. Involves the purchase, ownership, management, rental, or sale of the assets with the expectation of generating income, capital appreciation, or both. So it's a tangible property that you purchase. The benefits include, the ability to generate income through rent, value appreciation over time, which means that the value of the real estate property asset will appreciate over time. There's also a lot of tax advantages to having real estate or purchasing real estate, and also physical ownership. It is an actual thing that you own, right? Versus kind of stocks and bonds, which is little paper. It's kind of just paper ownership. The risk. What is the risk to owning real estate? Almost all the time, there's a high cost of entry. So you need a lot of money to get right into real estate to start purchasing it. Using loans to buy real estate investments can be very risky, especially if you don't understand the real estate market, and you're not familiar with the whole process of trying to capitalize on real estate investing. The value of real estate is heavily influenced by the property's location, market conditions, economic trends, local state government. There's a lot of things that affect real estate and real estate's value. So be aware of that if you're considering investing in it. Commodities. Just going to briefly go over this. I'm not an expert in commodities at all. Commodities is a raw material or agricultural product, such as metals, iron, gold, copper, as an example. Energy resources like oil, natural gas, or agricultural products like corn, wheat, or even financial instruments like futures and contracts. All those are commodities. The benefits include, you could diversify your portfolio and hedge against inflation and economic uncertainties using commodities. It's a whole rabbit hole going this way. I'm just gonna, again, just overview of commodities. The risks. It's very complex. Commodities are very complex, and there's a lot of speculation that goes into the value of commodities, right? Um, oil, barrel of oil could be up one day, down the next, significant volatility, depending on things like changes in supply, technological advancements, geopolitical policies, um, and then currency fluctuations, right? All those things affect commodities, so and more. So consider those. Collectibles. This is fun. I know a couple of people have collectibles. Collectibles is acquiring and holding tangible items or assets that are considered valuable by enthusiasts, collectors, or other investors. Collectibles can include art, antique, coins, stamps, memorabilia, so that's sports or movie memorabilia, toys, books, vehicles, right? Antique cars, wine, historic artifacts. Collectibles could be a lot of different things. The benefit of having collectibles is appreciation over time, right? If you have coins or stamps or collector car, the value appreciates over time. You can, while you enjoy it, right? You enjoy having the car, having a rare book, having a particular unique art, right? Um, ownership clout, right? You can talk about that very specific, very highly collectible item you have. It's kind of a great benefit, but the risk is that the collectible is very speculative. What does that mean? That means that the value is heavily influenced by the item's condition, rarity, significance, and the demand from other collectors. Because honestly, you may have a fantastic and very rare stamp collection, but the value is depending on what other collectors are willing to pay for your stamp collection, right? So things to consider: certificate deposit, um, also known as a CD. It's a type of deposit offered by banks and credit unions that provides a fixed interest rate, typically paid at regular intervals, such as monthly, quarterly, or even back into the account. The interest can be credited to the CD or paid directly to the account holder. So, benefits: CDs are relatively safe and predictable. The Federal Deposit Insurance Corporation (FDIC) insures CDs up to $250,000. So pretty safe. Again, not risk free, but pretty safe and very predictable because there's a maturity date of the CD. But the risks can include penalties for early withdrawal, right? If you need to get money out of your CD for an emergency, penalties can usually be very high. Fixed term, again, you can't cash in your CD whenever you need to, unless you're going to take a big penalty on it. And most CDs have minimum deposits, so could be $5,000, $10,000, and able to take advantage of the interest rate. Usually, there are certain deposit minimums. Also, interest rates may not be as competitive as other investment opportunities, and you're locking your money away for a particular amount of time. So, if you're considering a certificate deposit, and you really don't need the money, but you want to keep it somewhere where it's going to earn more than a savings account, it's a really great thing to consider. Annuities. Not going to talk too much about this because, to be honest, the California Department of Insurance, plugging them, CDI, they have a fantastic presentation about annuities. I just want to briefly go over it. What is an annuity? It's a financial product, usually used during retirement, that provides a series of payments at equal intervals, typically monthly or annually. An individual can pay a lump sum or a series of payments, known as premiums, to an insurance company or a financial institution to purchase an annuity. So the benefits include regular payments through a fixed period time. Also, if the purchaser passes away, the remainder of the payments can be received by the annuitant's beneficiaries. Risk. There's a lot of risk. There can be significant penalties for early withdrawal of your annuity. Annuities can also be very, very complex. Has many, many different fees, lots of features, requirements, terms. So be very, very careful if you're considering an annuity as a type of investment. Again, I I encourage you to contact the California Department of Insurance to look into them, get them to get their presentation about annuities and to learn about all the different things you should look out for. Hedge funds. It's a type of investment that is typically open to institutional investors or high net worth individuals. It's managed by a professional who invests in various assets, including stocks, bonds, currencies, alternative investments. So the benefits, it's professionally managed by a hedge fund manager. It employs diverse strategies to maximize returns. The risks usually include management fees, both management and performance fees. So yeah, hedge funds can have management and performance fees, and they can be pretty high, depending on how the hedge fund performs. It also requires a significant initial investment. Most hedge funds you can't get into unless you're investing a certain amount, right? Also, hedge funds can be very complex and they lack transparency because the hedge fund manager is the one managing everything, and they may not be disclosing all of the different assets that are in the hedge fund. So, things to consider there. Crypto assets. All right. Crypto assets, it's a digital asset, which may be a medium of exchange for which generation or ownership records are supported through a blockchain technology. A common issue consumers face with understanding how crypto assets work. Common issue is consumers don't understand how crypto assets work, and then they also don't understand what crypto assets are actually worth. The benefits of crypto assets, there's a potential for big returns, but there's a lot of risks. So I always caution everybody, do your research, do a lot of research when you're thinking about investing in crypto assets, because the risks are associated with speculation, right? There's minimal government oversight, and the legitimacy of the crypto asset could be very questionable, right? Who's issuing the crypto asset? Is it legitimate? There's a lack of transparency, not necessarily transparency of the ownership records, but again, transparency of who created this crypto asset, who is issuing it, what is the real value of the crypto asset, right? And again, the value is heavily influenced by other investors. So, crypto asset value can go up or down, depending on how many people buy into it, also how much money the crypto asset originator takes out of it, right? So yes, just a couple of words about crypto assets and the risk involved in there. Doing your research and managing risk. So spreading investments across different asset classes reduces the risk of losing everything all at once. This is also known as portfolio diversification. Doing your research, again, is the first step to managing your overall investment risk, right? Doing your research first before you start investing makes you a very informed investor to understand what you're putting your money into, what are you supporting, what are you buying. Common investment issues that you should research includes the rate of return of an investment, historic current pricing, performance, growth, leadership of that investment. So it could be a stock, could be a bond. Check out those historic current price, its performance and growth, leadership, valuation methods, right? So how is this stock, bond, other investment, how's it valued? Who valued it, right? Market trends and competition, right? You want to look at other players within that particular market to see how it would affect the value of that investment. And then another thing to consider is alternative investment opportunities, right? If you're looking to invest in something, consider other things. Again, doing your research, considering other investment vehicles that you could put your money into and how it would perform, as well as what other risks are involved, right? Okay, compound interest. This is my favorite thing. Honestly, it's a lot you could take away from this webinar, but this is kind of my number one thing that if you don't learn anything else, this is kind of the big one here. The rule of 72. It's a rule of thumb used to estimate the time to double your investment based on its rate of return. So you need to know the rate of return of the investment you're getting into. How do you use the rule of 72? Well, you divide the investment's rate of return by 72. So here's an example. Let's say you're in a mutual fund, right? You're in a mutual fund. Its average rate of return is 10%. You divide 10%, and that's literally, oh, sorry, this is flipped. It should be 72 over 10. I'll fix that later. Should be 72 over 10, which will give you 7.2 years to double your investment, right? So at a 10% rate of return, um, it'll take 7.2 years for your mutual fund to double in value, right? And then I provided a little chart here. So you're looking at, if you had a 15%, just kind of example, by the way, at 15% rate of return, it takes 4.8 years for your investment to double. 12%, you're looking at 6 years for your investment to double. If you have a 5% rate of return, it'll take 14.4 years for your investment to double, right? So why is this important? Here's a very, very good example. So here's an example of the rule of 72 in function, right? John has $100,000 in an investment that has a 10% annual return. So he's not going to do anything else. He doesn't put any more money into it. He has $100,000 right off the bat. He puts it into an investment with a 10% return. First year, right? 10% of 100,000. So first year he's going to make $10,000 on it, right? So that's what he has left. In the second year, you can see that it starts to compound, right? $121,000. In the third year, he'll have $133,000. So by year 7, because remember the rate of return is 10%, and you take 72, divide that over 10. So in 7 years, you go from $100,000 investment, even if John does nothing else, he puts no money into it, it just sits, and it's a consistent 10% annual rate of return, you're looking at $200,000. So in 7 years, it'll go from 100,000 to 2. And then let's say another 7 years, it goes from 200,000 to 400,000. In his 21 years, after 21 years, it goes from 400 to 800,000. And by year 28, you're at $1.6 million. So $100,000 in an investment that is consistently giving you 10% annual return. In 28 years, it'll give you $1.6 million, right? And if John does nothing for another 7 years, it goes from 1.6 to 3.2. So that is the rule of 72. Again, it's kind of a rule of thumb, and it's based on annual return. You got to know your annual return, and that's a good way to judge the differences between investments, right? Investments might have one rate of return, higher rates of return, but then a lot higher risk. So using this rule of 72, you can think about, hey, I have an average over my entire investment portfolio. I have an average rate of return of 10%. I can expect every 7 years my portfolio doubles in value. So very important thing to remember and to understand. Okay, now we're going to talk about some common investment fraud and scams. Just a very high overview here. Ponzi schemes. Again, that's where the Ponzi scheme scammers, they take investors' monies to pay other investors, and then of course it just kind of snowballs or balloons into this huge debt cycle, right? Taking money from Peter to pay Paul, but then you need to keep bringing in more investors so that you could keep paying those other investors you already have. Pyramid schemes, again, that's essentially where you need more. It's very similar to a Ponzi scheme, but it's where you need more individuals to continue to invest to actually make money. Affinity fraud, that's fraud where that targets people of particular demographics or age. This type of fraud is again targeting demographics. Boiler room scams, so that's something like high pressure sales on investments that have very overvalued or have no value. They're just trying to get you to buy in. Pump and dump schemes. This is, oh my gosh, this is such a popular thing influencers get into, what happens is someone will pump up a stock or pump up a value of an investment. And then when a lot of people get into it and the value goes high, those early investors take all the money out and they leave everyone who, and the value of the investment crashes, right? And so everyone else who's come into the investment loses money. Advanced fee fraud, that's like investments that have and fees that they charge before they do anything. Real estate investment scams, there's a lot of different types of real estate investment scams, things like selling a house that doesn't exist, or selling a house that doesn't belong to that seller, or there's a number of different types of real estate investment scams. Selling real estate that has no value, right? Or taking your money without even buying the real estate for you. Precious metals and commodities. So precious metals. I don't want to go down the rabbit hole when we talk about precious metals and other commodities, but precious metals in general have a lot of issues with it. It's not bad. It is a type of investment, but the problem is some people who sell precious metals are doing it, are misleading investors or not disclosing all the information they need to. So things like rate of return, or even if it's a complete scam, someone says, I'll buy gold for you, they take your money, they never buy the gold, or they never deliver the gold to you, or they're charging you large fees to hold on to your precious metals or gold or other things, right? And then of course cryptocurrency scams. Cryptocurrency, since it's relatively new, there's been a lot of scams associated with it, again because it's just so new, and a lot of it is just not regulated. All right, so how to protect yourself from investment fraud and scams. Research, right? Research your investments, avoid high pressure sales. Beware, again, we talked about this, beware of guaranteed returns. All investments carry some level of risk, right? There's no such thing as a guaranteed return. Check credentials. You want to verify the credentials of financial advisors, brokers, investment professionals. Go to the DFPI's website, dfpi.ca.gov/verify. We have a website where we license, because we license financial advisors, investment advisors, brokers. Check to make sure they're licensed, right? Of course, you want to use strong passwords and secure your devices, right? That's where you have access to all your different accounts. You want to be cautious of investments that have no transparency, lack transparency. They fail to provide clear documentation. You want to make sure that the investment you're getting into, it has some kind of legitimacy, right? Also, if you're not sure, you could always seek professional advice, right? Before making a financial decision. Investing is a huge decision, financial decision, and it's not always wrong just to go get some financial advice. And of course, if you do have, notice any kind of suspicious activity, report it to the DFPI. You can also report it to the FTC. Our link is dfpi.ca.gov/submit-a-complaints. You submit any kind of complaint or suspicious activity you see, and we'll investigate it. Again, you can also report it to the FTC through their link, reportfraud.ftc.gov. All right, with that, I want to hand it off to Diana Sanchez from ScholarShare 529. ScholarShare 529 is a fantastic way to save for college. I myself have 2 different ScholarShare accounts for my boys, and it's very surprising. I just set it to a monthly amount, and then I check at the end of the year, and I'm very surprised at how much it grows. So with that, Diana, please take it away.
Thank you so much, and I appreciate that. Very informative information as well as on investments. Again, my name is Diana Sanchez. I'm an outreach specialist for the ScholarShare Investment Board and the CalKids program with the State Treasurer's Office. So I'm just going to go over a little bit about the ScholarShare 529 plan. Next slide, please. So a little bit about the ScholarShare 529 plan. So this is California's official college savings plan. There are many plans out there. Many states have their own 529 plan, but this is California's official 529 plan. We have been in the business for over 20 years helping families save. currently have over $12 billion in assets, which means student savings for higher education. We are overseen by the ScholarShare Investment Board, which is chaired by the California State Treasurer's Office, Fiona Ma. Next. So what is a 529 plan? So a 529 plan is basically an investment specifically for higher education. You have like your retirement funds. 529 is specifically for higher education. Any of the earnings is tax deferred. As long as it's used to pay for higher education, it is 100% tax free. And it could be used at many accredited institutions in the nation that accept federal financial aid, including 2-year, 4-year technical schools, apprenticeships, any accredited institution that accepts federal financial aid. The funds, they can be used for books, tuition, room and board, internet service, anything that's required for that class. So who can open an account? Well, any U.S. citizen or resident has to be at least 18 years of age or older with a valid Social Security number or taxpayer ID number. You can even open an account for yourself. Next. So how are your savings invested? Well, thank you, Q, for giving us a lesson on investment options. With the ScholarShare 529, we have various options to choose from. We have a guaranteed portfolio, which offers you a stable rate of return, similar to like a regular savings account. So for those families who are not comfortable with investing their money or are not sure about what portfolio to choose, many start here. And then they can do a little bit more research to potentially go to a different investment. You can change investments twice a year, and you can change the name of the beneficiary at any time. We also have our custom-built portfolios where those who are a little bit more savvy on investing can build their own portfolios based on their single and multi-funds. Or we have our most popular, which is our enrollment year investment portfolio. And this is based on the year the child or the student is expected to enroll in higher education. So it could potentially give you a little bit more time to invest your money. Say your student graduates and they already have a scholarship and they want to use that money first. They can leave this money in the 529 and use it later on. Next. So keep more of what you save. With the ScholarShare 529 account, we have one of the lowest fees of any of the 529 plans out there. Because we are a direct sold plan, we don't have advisors selling for us. You don't pay those commission fees. You don't have an application fees, or when you change investments, you don't have any fees. Again, you can change investments twice a year. And there's a minimal impact on financial aid. So it's looked at as if it was the parent's asset, not the student's. Next. So who is eligible? As I previously mentioned, anybody can open an account. Usually the account owner is a grandparent or a parent. It could be an aunt and uncle. It could be yourself. You can open an account for yourself or even a next door neighbor. You don't have to be related. You do have to be a U.S. citizen or resident age 18 years or older with a valid Social Security number or a taxpayer ID number. And then when you set up an account, people are concerned, well, what happens to the account if something happens to me? With the ScholarShare 529 account, when you first open that account, you got the option to designate a successor, which would take over the account should something happen to you as the account owner. Now, the beneficiary is typically your children, your grandchildren. Again, you could be yourself, but it could also be like a godchild or your niece or nephew. It does not have to be your relative. but they also must have a valid Social Security number or taxpayer ID number. And you can only have one beneficiary per account. When you get ready to use your funds to pay for higher education, it will only be available for that one beneficiary. So if you have two students in college at the same time, you would need two separate accounts to be able to subtract or deduct from those accounts to pay for that specific student's expenses. Now, contributions anybody can contribute into a college ScholarShare 529 account. We have a program called U-Gifting where family members can contribute, say for birthdays, graduation, holidays. Christmas is coming up. You can send them a little email link. They can click on there and contribute directly to the account. It's secure and safe, and it's an easy way to have family members, help save for higher education. Next. So how do you apply? You can go onto our scholarshare529.com, or you can call our 800 number and speak to somebody directly. It should only take you about 15-20 minutes to set up. What you will need is you need to have the name of the beneficiary, and you'll need their Social Security number, and then decide how much you want to save, whether it's $1. You can open up an account for as little as $1. You don't have to have automatic deposits, but you can set it up through your own bank or with the state controller's office. You can set up automatic payroll deductions as well. Now, the contributions are after tax. So your payroll department takes care of all of that. And then if you are going to be doing it through your own bank account, make sure you have your account number available when you get ready to sign up. You want to choose your investment portfolio. Again, we have the guaranteed funds, we have the enrollment years, so just know which portfolio you'd like to choose. And then how are you going to fund it? Again, are you going to do it periodically? Do you want to do it through your bank? Are you going to do payroll? Workplace savings is through your payroll. So you can set it up either way. Next slide, please. So I'm going to talk a little bit also about our CalKids program. This is a new program that was started last year. It's basically a college savings account for two groups. Next. This program was started last year of 2022, where we're trying to set up accounts for all newborns born July 1st, 2022 are eligible to receive a CalKids account, and all eligible low-income public school students will also be awarded a college savings account. Enrollment is automatic, and families are not required to contribute. As a matter of fact, you cannot contribute to a CalKids account. Go ahead. Next slide, please. So a little bit about the award structure. First, for the newborns, again, every newborn born July 1st, 2022 going forward would get a $25 college savings account. But beginning this year, July 1st, 2023, we were able to increase that. So now children will get an initial deposit of $100 in every CalKids account. Now, if your parent or guardian registers this account on the CalKids portal, you get another $25 deposited into that account. And then if you open up a new or existing ScholarShare 529 college savings account and link that to your CalKids account, you get another $50. And by linking that, it's basically giving you the option to view both accounts in one portal. You cannot interchange deposits. You cannot transfer funds from one to another, but you are able to see everything in one portal. Thank you. Next slide. So now for the school-age children, is determined, the eligibility is determined by the local control funding formula. That information we get from the Department of Education. So those students who are eligible would get a $500 automatic deposit into a CalKids account. Now, if the child is identified as a foster youth, they would get an additional $500. And if they are identified as homeless, they'll get an additional $500 to that account as well. Next, please. So how does it work? So basically, children born in California and eligible first through 12th grader students receive a CalKids account with a seed deposit. Now, families can link at their own ScholarShare 529 account to maximize growth. Again, you can't contribute into the CalKids account, but you can with the ScholarShare 529 account. And then like the ScholarShare 529 account, it could be used at any accredited institution in the nation that accepts federal financial aid for books, tuition, room and board, things like that. The check will go directly to the school that the child is enrolled in. Next. Okay, how do I determine eligibility? So quickly, you would go on the calkids.org website. Under the Basics tab, you would select eligible for a CalKids account, and then you would determine whether you want the section for the newborns or the section for the student. And then for the students, you would need their statewide student ID number or SSID number, which you can get that from the school. For the newborns, you would need their local registration number, which can be found on their birth certificate. Next. So to register, you just go on the calkids.org website and enter that information. You'll need their date of birth and their county. You do not need a social security number, just their statewide student ID number. Next. Now here's some resources to look up to get additional information. There's YouTube videos, there's frequently asked questions, and email. If you'd like to speak to somebody directly, you can also call the 800 numbers. Thank you. This is my contact information. If you have any questions, be glad to answer any. Thank you.
Okay, great. Fantastic presentation on ScholarShare 529, also CalKids. Two very wonderful programs. Again, I'm a big proponent. I plug ScholarShare wherever I can. It's very easy to see that child's education fund grow, and without doing too much work, right? Okay, so we have a lot of questions. Well, we have 8 questions. A lot of them are actually about ScholarShare. So let's go ahead and jump right into the Q&A session. Okay, first question, can I get a copy of this presentation? Yes, this presentation, for everyone who registered, you will receive the copy of the slides, as well as a link to our YouTube video. So again, we're recording this, we'll be publishing into our YouTube channel. I will include that link in a follow-up email after this webinar. Okay. Next question, are 529 plans transferable? Diana?
You can transfer a 529 plan to another 529 plan, but not to like a savings account or anything like that. It can just be another 529 plan.
Okay, very, very good. Are there penalties to withdrawing from a 529 to buy a house?
Yes, if you use the funds on a 529 account to pay for anything other than higher education, you will be subject to penalties and taxes, but only on your earnings, not your contributions. Your contributions are after tax. So you still can use it for that.
Cool, very cool. Here's a good one. 529 is good, but what if the kid chooses not to go to university let's say chooses not to go to university and go to city college instead? what's the benefit of 529? Are we going to pay taxes on that investment if we don't use it for expensive tuition fees?
Uh, uh, okay, so first part of it is as long as the city college is an accredited institution, you can use it to pay for city college, or if the child decides not to go to or to a university that's accredited, you can save those funds for your child's children, or you can transfer it to another beneficiary, another child, or if you decide you want to go back to school, you can transfer those funds back to yourself. It can there's no limits on how many times you can change a beneficiary. The account does not expire as long as the funds are there. Are you going to be paying taxes on investments if you don't use this for expensive tuition? Again, it could be used for books, for computers, for internet service. And the taxes, if you don't use it to pay for higher education costs, the taxes would be on the earnings only, not your contributions. And then there is also a fee to a penalty fee for the funds that aren't used to pay for higher education, but again, only on your investment. Excuse me, the
Education. So maybe a question for myself here. What if your child decides to go to like a nursing program that's not through university or college? Maybe it's through like a vocational program that can be paid through by.
the technical vocational schools are also included. The way you can find out for sure is go on the FAFSA website and type in the name of the school. Ask them if it's an accredited institution, it'll come up, or contact the school directly. Ask them if they are an accredited institution that participates in the FAFSA program.
Cool. And then of course the 529 is paid directly to the school. Is that right?
The 529 can be paid to yourself, to the school. We don't ask for any receipts. We just ask that you keep them in case you get audited. So you let us know where the funds for the 529, where you want them to go to. And the benefits is that you don't pay any taxes on the earnings as long as they're used to pay for higher education.
Great. And that's a great question. All right. Next one. This one is very similar. If my child decides not to go to college, is there a way to withdraw money or close the account?
Yes, again, you can take those funds out as a non-qualified withdrawal, but they again would be subject to penalties and taxes on the earnings only, not your contributions.
Awesome. Very awesome. A lot of 529 questions.
Yeah.
It's good. It's very good. Again,
Yeah.
looks like people
And
are
this
very.
one here, there are specials coming up. We will be having one in December. I believe that's going to be a $50 gift card. If you open an account for $50 and set up automatic deposits of $50 for the first 6 months, and then you'll get a $50 gift card again. That's going to be in December, the beginning of December. We'll be getting that information out probably next month.
Awesome. And usually those specials run for like a month.
It depends on the special. This one may be running maybe for 2 weeks.
Oh, okay. Wow.
But I can't say for sure. The details are still being worked out. But yeah, sometimes a month, sometimes 2 weeks.
Might have lost.
Yeah, we'll send that information out.
Okay, might have lost Dana. But yeah, so thank you for the special. Could be coming up in December. Hi.
Yeah.
Hey, Diana. Okay. Is there limit to how much I can contribute to a 529 account?
You can contribute. I believe it's 130,000 a year before you get into that gift tax. I would talk to your tax advisor about that, but I mean, ideally you can contribute whatever you want, but then you get into the gift taxing part of that, which is I'm not a tax consultant, so we can't advise on that. So, yeah.
Very good. Thank you, Diana. Okay. What is the benefit of a CalKids account? Is it one-time deposit?
Yeah, so a CalKids account is a brand new account for again, family members who are eligible. For the students, again, it's money that is invested. You do not need to apply for it if you're eligible. The account is already there. You would just need to register to be able to access those funds when you get ready to use it for higher education. So let's say the people in 2022, we opened accounts for as a high school student for $500. That account is currently investing. It's being invested, so it's earning interest right now. So if you don't apply for it until, not apply, but register for it until this year, you'll see that it's going to be a little bit more than $500 because it's been investing since it initially opened. You cannot contribute into the account. You have to use those funds by age 26. The account is owned by the state of California, and it's free money. You don't have to pay it back. But it must be used to pay for, it's going to be sent directly to the school for those CalKids account.
Okay, perfect. Thank you, Diana. Looks like that's the end of our questions. So with that, I do want to do some final housekeeping items. Reminder, hey, subscribe to the DFPI's monthly newsletter. We publish, great information, consumer alerts, as well as highlighting events that are coming up. Subscribe to our YouTube channel where you could see this webinar and many others that we publish there. We need your feedback. Let me know how I can do better. Did I talk too fast? Is there too many slides? There's a link there. Please take our survey. Let me know how we can improve these webinars, these presentations. And finally, next month's financial education webinar is Shop Smart and Safe. It's on November 22nd at noon. You could register for this free webinar with that link right there. With that, I want to say thank you. Thank you to Diana for the great presentation. Thank you all for taking the time to join us. And please take care of yourselves and each other. Bye.
Thank you.